Imagine you buy a brand new machine for your business. It is expensive, but you will need it for several years. So how do you represent this significant expense in your accounts without drastically affecting your results in the first year? The answer is depreciation. Depreciation is a regulated accounting operation. According to the Commercial Code and the General Accounting Plan, depreciation corresponds to the recognition of the loss of value of an asset related to its use, physical wear, technical evolution, and obsolescence of the asset. Or simply the passage of time. In short, it involves spreading the cost of an investment over its probable useful life. Let's take a concrete example. You buy a machine for 50,000 euros that will last 5 years. Each year, you record a depreciation expense of 10,000 euros. This expense thus reduces your accounting result each year. A company must depreciate all assets intended to remain permanently in its assets as long as their useful life is limited. It must be able to estimate the economic benefits that each asset will bring it, and determine the rate of consumption, often measured through cash flows. In practice, yes sounding the assets subject to depreciation are mainly tangible fixed assets, buildings, machinery, tools, computer equipment, or even furniture. And certain intangible assets like patents, licenses, software, or even business goodwill under certain conditions. Note that land and works of art are generally not depreciable, just like financial assets, which can sometimes be impaired. A tax tolerance allows companies not to capitalize and therefore not to depreciate certain assets that should be. This measure concerns low-value assets of a certain nature. There are 3 main methods of depreciation. The first is straight-line depreciation. The expense is spread equally over the useful life of the asset. Secondly, declining balance depreciation. It is more advantageous at the beginning, allowing a fixed rate to be applied to the remaining net book value, thus reducing depreciation expenses each year. And finally, the unit of production depreciation. The expense directly depends on the actual use of the asset, such as the number of hours a machine is used or the number of units produced. In accounting, the depreciation of a fixed asset begins from the date it is put into service. This is the date from which the asset is ready to operate according to its intended use. Depreciation thus plays a doubly strategic role. First, it will accurately reflect the actual economic wear and tear of the company's assets, and secondly, it will help anticipate their future renewal, thereby contributing to optimized investment management.